What's up everybody, welcome back to my YouTube channel. I am Riza Ramzani and this is Business Ideas. I hope you all have a great week. For today's video I think it's better to talk about something every investor need, which is how invest based on age. By the way, before starting the video make sure you hit the like and subscribe button. It helps us to get more energy from you guys and encourage us to make more and valuable videos. Okay, let's start the video. The old rule of thumb used to be that you should subtract your age from 100 and that's the percentage of your portfolio that you should keep in stocks. For example, if you're 30, you should keep 70% of your portfolio in stocks. If you're 70, you should keep 30% of your portfolio in stocks. However, with humans living longer and longer, many financial planners are now recommending that the rule should be closer to 110 or 120 minus your age. That's because if you need to make your money last longer, you'll need the extra growth that stocks can provide. What is asset allocation? Asset allocation simply refers to the specific allotment of different asset types in one's investment portfolio based on personal risk tolerance, goals, and time horizon. The three main classes are stocks, equities, fixed income, and cash or cash equivalents. Outside of those, in the context of portfolio diversification, people usually consider gold, metals, and REITs to be their own classes too. Why is asset allocation important? These different asset classes behave differently during different market environments. The relationship between two asset classes is called asset correlation. For example, stocks and bonds are held alongside one another because they are usually negatively correlated, meaning when stocks go down, bonds tend to go up, and vice versa. That correlation between assets offers a diversification benefit that helps lower overall portfolio volatility and risk. This concept becomes increasingly important for those with a low tolerance for risk or for those nearing, at, or in retirement. And equity risk factor diversification may be just as important as asset class diversification. It's widely accepted that choosing an asset allocation is more important over the long term than the specific selection of assets. That is, choosing what percentage of your portfolio should be in stocks and what percentage should be in bonds is more important and more impactful than choosing, for example, between an S&P 500 index fund and a total market index fund. Vanguard actually determined that roughly 88% of a portfolio's volatility and returns are explained by asset allocation. Think of asset allocation as the big picture framework or foundation upon which your portfolio rests, before moving on to the minutiae of selecting specific securities to invest in. Asset allocation and risk tolerance. Remember, one of the major factors in determining one's asset allocation is personal risk tolerance. Stocks are more risky than bonds. Buying stocks is a bet on the future earnings of companies. Bonds are a contractual obligation for a set payment to the bondholder, because future corporate earnings, and what the company does with those earnings, are outside the control of the investor. Stocks inherently possess greater risk, and thus greater potential reward, than bonds, so why not just invest in bonds? Again, stocks tend to exhibit higher returns than bonds. Investing solely in bonds may not allow the investor to reach their financial goals based on their specific objective. And unexpected inflation can potentially be damaging to a bond-heavy portfolio. On the flip side, investing solely in stocks maximizes volatility and risk, creating the very real possibility of losing money over the short term. Holding bonds reduces the impact of the risks of holding stocks. Holding stocks reduces the impact of the risks of holding bonds, such as the beauty of diversification. Depending on time horizon and market behavior, holding two uncorrelated assets can result in higher returns and lower risk than either asset held in isolation. With a smoother ride. William Bernstein proposed that an investor can evaluate their risk tolerance based on how they reacted to the global financial crisis of 2008. Sold, low risk tolerance. Held steady, moderate risk tolerance. Bought more, high risk tolerance. Bought more and hoped for further declines, very high risk tolerance. Take a risk level that lets you sleep at night. Most investors severely overestimate their tolerance for risk, only realizing their true risk tolerance during a market crash when their portfolio value tanks. The behavioral aspect of investing is unfortunately very real and can have significant consequences. Emotional responses to one's environment, in this case a financial environment, are hardwired in the human brain. Asset allocation by age calculation. There are several quick, off-site model calculations used for dynamic asset allocation of a portfolio of stocks and bonds by age, moving more into bonds as time passes. For the sake of clarity and consistency of discussion, we're going to assume a retirement age of 61. The first and simplest adage is age in bonds. A 40-year-old would have 40% in bonds. This may be fitting for an investor with a low tolerance for risk, but is far too conservative in my opinion. In fact, this conventional wisdom that has been repeated ad nauseum goes against the recommended allocations of all the top target date fund managers. This calculation would mean a beginner investor at 20 years old would already have 20% bonds right out of the gate. This would very likely stifle early growth when accumulation is more important at the beginning of the investing horizon. 2. Another general rule of thumb is a more aggressive for bond allocation. This calculation is much more in line with expert recommendations. This means the 40-year-old has 20% in bonds and the young investor has a portfolio of 100% stocks and no bonds at age 20. This also yields the stalwart 60/40 portfolio for a retiree at age 60. 3. A more optimal, albeit slightly more complex formula may be something like: this means bonds don't show up in the portfolio until age 40, allowing for maximum growth while early accumulation is more important, then accelerating the shift to prioritizing capital preservation nearing retirement age. This calculation seems to most closely follow the glide paths of the top target date funds. Generally speaking, it could be said that these three formulas coincide with low, moderate, and high risk tolerances, respectively. Asset allocation examples. Let's look at some examples of asset allocation models by age. Using for bond allocation, a starting age of 20 and a retirement age of 60. A one-size-fits-most allocation would be 80/20. This fits a young investor with a low risk tolerance and a middle-aged investor with a moderate risk tolerance. Both the formula and the formula would result in a traditional 60/40 portfolio, considered a near-perfect balance of risk and expected return. For a retiree at age 60, several lazy portfolios exemplify nominal asset allocation models. Warren Buffett portfolio, 90/10. No-brainer portfolio, 75/25. Larry Swedroe portfolio, 30/70. In any case, remember to rebalance regularly so that your asset allocation stays on target. Well, this is for today's video. Hope it helped you to understand how you want to diverse your portfolio. Well, thank you for watching this video. I will post new video every week. And as I always say, never let your goal goes.